I will go ahead and get started. First and foremost, great to see everyone on the call today. We're excited to talk about an exhilarating and amazing topic of taxes. So thanks for joining us today. Really the goal today is to make sure that we go over any pertinent changes or updates here in 2022, and really make sure we touch on a multitude of topics that benefit or not benefiting us as real estate owners or investors. So we're going to go over the updated laws and any provisions for the Fed, the state, touch on Prop 19 with the child parent transfer. We're also going to talk about the 2 of 5 year capital gain exclusion benefit. And we're going to make sure that we open it up to any questions that you might have at the end. Really want to make this a purposeful and intentional conversation. And we're excited just to get education and take action as we see appropriate based on our information we go over with Jesse. So with that being said, I did want to thank you, Jesse, for sharing some time with us today. Jesse is someone that I've been in business with for 10 years now, and he's been a tremendous help for our community with the Emerson Group to help keep us informed of what's going on from year to year, providing countless one-on-one client consultations for tax advice and planning, and really just being an asset for long-term wealth accumulation and tax minimization. How about that?
Love it.
So we'll kick it off to Jesse to get the call started.
Thanks, thanks a lot, Nick. And everybody, what Nick said is super important. Listen, we're talking taxes. It's boring. It's dry. If you have questions, go ahead and ask. You know, whether it's just verbally or through the chat. But we'll do our best to engage you and try to make this stuff understandable. Really, status quo 2022. Not a lot of big changes for real estate investors. Matter of fact, Section 1031 exchanges were in trouble for a minute, but they are safe for now. We're going to talk about opportunity zones and why they haven't changed, but they kind of changed. And then we're going to address the Build Back Better. It didn't pass. It had sought to close a quote loophole on the non-deductible IRA to Roth conversion strategy. So I'll explain that. That is safe for now as well. 1031 exchange, I know, Nick, you do a lot of workshops on this, won't spend a lot of time on it. To me, it's the most powerful strategy when it comes to the accumulation of wealth in real estate, okay? Opportunity zones is a Trump tax reform opportunity, as it will, where you can take your capital gains and reinvest them into designated zones, that property zones that are designed for re-improvement. Interesting part of it's always been that you don't need to reinvest your basis, just your gains. So if you have a $1 million property that you bought for $100,000, you can literally just put the $900,000 of gains in it and keep the 100. The one sunset provision that's already impacting us is that if you had held it for 5 years before 2026, okay, so meaning you would have had to sold in 2021 and then put the money into the opportunity zone before December 31st. If you hold it for 5 years, then you'd get a 10% free basis. In other words, you'd defer $1 million of gains. So long as you had it for 5 years, they would treat it as if you only had $900,000 of gains, and then you pay the taxes, you know, at the end of 2026. I've never been a real big proponent of this, simply because it's not like a 1031 exchange where you get to defer the taxes indefinitely. It was always you were going to pay taxes at the end of 2026. And where there, you know, some people it works out good. It's really just kicking the can down the way for a little bit, you know. So enough on that. if we're talking about what is commonly referred to as the backdoor Roth conversion, I want everybody to understand why this strategy exists in the first place. And it's as simple as this. And this is straight from Irish Pub 590. If you're single and you've got a 401k at work, you can always contribute to an IRA, but if you make more than $76,000, you can't get a deduction for it. Same thing applies if you're married. If you're covered by a retirement plan at work, you make over $125,000 together, you can't put money into an IRA and get a deduction. You add that to the fact that a married couple making over $208,000 can't contribute to a Roth IRA, or a single person over 140, and you're kind of in this conundrum. You know, you want to save more money for retirement. What can you do? Well, let's do an easy example. You're married, you make over $208,000. Okay, you can't contribute to a Roth IRA. That's more than 125, so you can't get a deduction for putting money into a traditional IRA. What can you do? You can contribute $6,000 to the non-deductible IRA and immediately convert it to a Roth. $6,000 no deduction, $6,000 converted, no taxes. That's what it is. And so for now, with Build Back Better not passing, you can still do this. Okay. So that is the extent of our changes here for 2022. Prop 19 is now almost a complete year in its implementation. Okay, from February of last year to now, actually, it is a full year. Let's quickly define terms. Now, this, just so we're all on the same page, what is Prop 19? California Proposition 19 from 2020-2021 is all about property taxes in California. So if we're going to effectively define the terms here, your assessed value, AKA your factored base year value in California, is what you bought the property for, plus no more than 2% annual increases due to a law called Proposition 13. Okay, I know across the country, assessments are based upon current market value. Prop 13 artificially keeps California property taxes low until there's an event. So, like, for example, if you add a pool to your home, or you add square footage, independent of Prop 13, your home will be reassessed. Okay, and then obviously market value, when you sell your existing house, that's market value, and when you buy, that's right. That's pretty easy. But understanding that, quick disclaimer for Prop 19, the California's Board of Equalization has a wonderful piece on understanding Prop 19. Okay, and I'm actually going to reference the updated charts as of today in this presentation. Okay, and if you can't see this, I can maybe pull up the actual website. Nick, can you see this okay?
Yeah. And one thing I wanted to say too, real quick, is I thought this was important to bring up. Karen, I see you're on the call today. That's awesome. Right. This is the first year where people are filing taxes with the Prop 19 new provisions in place. So I'm getting calls on people that have inherited property, right? If it's a rental, does that mean it's going to be reassessed? And I was uncertain of this. Or, hey, if I'm going to transfer it to a child after 2021, what does this mean? So this is a big conversation right now. We're starting to see this is the first tax filing year where this goes into place. So I wanted to make sure Jesse went over this because it's important for your long-term planning and maybe what your thinking is behind it, right? Well, with people inheriting property, if they're going to inherit a larger tax basis, is it still a viable investment? Right. Well, these are the kinds of questions. So Jesse, go for it.
We have to kind of do a balancing act here. Prop 19 is better for homeowners then it is worse for people inheriting things. Okay. Now, when I show you how it works for those that are inheriting properties, you might disagree and say, wait a minute, they're getting a really bad deal. But it's your blood, sweat, and tears that is factored into you buying a home. And so if you're a California homeowner, you now have the ability to transfer your property tax base up to 3 times anywhere in California and not be reassessed if you stay same or less, and only be reassessed on the overage if you go up in value. This is a huge victory in a place where even if you bought a home a couple of years ago, you may have a couple $100,000 of gains, right? And as we'll explain here, how the factored value works in California because of Prop 13, our actual assessed values are dramatically lower than they would be. And so this is a huge win for homeowners. On the flip side, it really is horrible for the people inheriting properties. It used to be, if it's your primary residence, it doesn't matter what the limit is, your kids get it, doesn't get reassessed. Clean, easy. Also, other property, if you had a rental property that was being assessed at less than $1 million, which is a very, very common thing. Not the value, not the market value, the assessed value. There weren't any reassessments either. Prop 19 makes it so that if it's a rental, it's getting reassessed, period. And if you guys are out of state listening to this, this is monstrous. This is a huge deal. And I'm going to show you actual numbers here in about 10 minutes that change potentially your inheritance strategies, inheritance planning strategies. Regarding the transference of a primary residence to an adult child, I mean, it has to be your primary residence and it has to be their primary residence, and the assessed value plus it's limited to the assessed value plus $1 million versus current market value. So there's a lot of hand in government in this. I think as we go through actual examples, and by the way, I don't know if you can see the bottom of the screen, this is the big change for real estate investors, and this is effective as of February 16th of last year. So let's kind of go into some online tools you can use. And I'm going to use both of these in the following slides. Okay,
and Jesse, real quick, just want to pause. If anyone has any questions, I just want to remind you, please go to the bottom toolbar, wherever it might be on your screen, raise your hand or put the question in the chat box. So I want to make sure that we're addressing, right, questions from the people attending the call. So go ahead, Jesse.
And listen, this is a brutal, like Prop 19's hard to understand. Okay, if you have a question, please, like Nick said, please ask. I've actually given this presentations almost to 1,000 agents at this point, and I constantly get kind of like the same question, you know. But here's a property, Tierra Santa, California, San Diego. Let's utilize this property to find the following information. Okay, so first we're going to go to the San Diego County Tax Collector's website, put the address in, easy. It'll show our tax rate, 1% California tax rate plus all the San Diego bonds, 1.22, 1.23% tax. And after a couple of littles there, it's $972 a year. Okay, that's the real tax rate, what they're really paying in taxes right now. And what is our assessed value? Well, same website, by the way. Actually, first part of the results, you'll show it's being assessed at $76,000. Perfect. We go to realtor.com, shows this property was bought in 1972 for $32,500. Also shows current estimated value at $777,000. So let's look at this. We see the taxes, we see the assessment, the factored base value. what you bought it for, what it's worth today. Okay, that's all the answers to the quiz here. Now, let's put this into Excel. Okay, under Prop 13, your taxes are kept low. You bought it for $32,500. It's capped at 2% a year. That's why it's currently being assessed at $76,000, even though the market is $777,000. Okay. If we didn't have Prop 19, let's suppose that this person sold their property and bought a $1.277 million property. The old prop, prior to Prop 19, California 6090, it was only for downsizing. And so therefore, you would have been reassessed on the whole purchase price. And I'm talking about sticker shock, $900 a year to $15,000 a year. Okay. With Prop 19, you maintain or you laterally transfer the assessed value, and you only pay taxes on the overage. So I made this example very easy. I just said 76, $500,000 difference. So you add that to what you're already paying taxes on. Bottom line, you go from $900 a year to $7,000 a year. It hurts, but it doesn't hurt as bad as $15,000. Okay. On the flip side, had this been a lateral transfer, okay, you would have stayed at 972. Okay. But if you go up in value, now this is for your primary residence. This is not an investment property. Let's take a look at an investment property that you want to pass on to your kids. Okay. Well, through February 15th of last year, the same exact property, let's say it was now worth 1.2. Okay. The assessed value is only 76,000. So remember, we talked earlier, there's that $1 million limit in passing. Here, and I'll go back here and I'll show you. There's a $1 million limit on the factored base year value in inheritances. Well, this is 76,000, well under $1 million. So the limit really doesn't apply. So your loved ones would inherit it at 942. However, now it's an investment property, ergo, it immediately will be reassessed upon your passing from $900 a year to $15,700 a year based on current market. And there's really no way around it. It is what it is. There are frequently asked questions on the BOE website. What says, well, what if we had it in a trust, right? Wouldn't it, in the trust, it shouldn't be reassessed because there's not a change of ownership. And it actually discusses the fact that when the original trustors, the original grantors of the property, when they pass away, that's considered a taxable event for reassessment. Okay. So as we go back now into, understanding Prop 19, let's talk about your options. I really believe that there's two groups here. There are owners of real estate that is their primary residence, and the adult children who are set to potentially inherit the rentals. Okay. Look, our market's crazy right now. It's kind of like the stock market. It's way high. If you're considering selling your house and you've got $500,000 of equity, you can literally sell right now today completely tax-free. Like if you've got $500,000 of equity in your home, you've never rented it, it's you and your spouse, you sell it right now, you travel the world, and 2 years from now, come back in and still transfer that old property tax basis utilizing Prop 19. It doesn't matter if the property you buy is higher or lower than what you sold, because I have not yet talked about this, but there's some fine print here. It's kind of neat. Look at this. Okay. Prop 19 carried over a little asterisk in Prop 60. And it's this. If you replace the property in the second year after sale, you actually can go up 110%. So let's put some numbers on that, just visualizing. This is your primary residence. You buy it for $500,000. You sell it for $1 million. You've never rented it. You've lived in there the last 2 years. So what happens? You've got a $500,000 tax-free gain. You sell it, you're out. If you sell it in 2022, you've got 2023, 2024, you can buy a new primary residence in California, not for $1 million, but rather $1.1 million and still transfer your original basis. This is huge. Like, remember I said, Nick, Prop 19 is much better for owners than it is worse for inheritees. I think this is tremendous. Okay. Now I think we got a hand up here.
Yeah, Karen had a question.
Okay.
Karen, I'll go ahead and allow you. We'd love to hear if you would like to ask it live. If you want to unmute yourself.
Okay.
Hey, Karen.
My sister and I inherited my mother's home in San Diego about 28 years ago.
Okay.
And our tax base, of course, is under Prop 13. So it's $1,000 a year.
Nice.
I I understood years ago that if there wasn't to be a capital gain, we had to each live in the house for 2 years. Now, I plan to live in the house next year for some number of years. I don't know how long. She probably will not live there at all. I have 2 sons. She has no children. My half will go to my sons. And if she is left with the 2 boys, what is the tax consequence?
Karen, this is a great example. It covers so many different things. Let's actually draw what's going on. Okay. So there's a nope, not going to do that. Let's draw with the square. All right. So here we have this house, and the house is owned by 2 sisters. Yeah. So it's owned by Karen and Karen's sister. Okay. Easy, right? Now, the really big thing to understand here is you said that you inherited it some 25 years ago. Let's just for argument's sake say, just easy, so I give us some easy numbers here. Let's just say that you inherited right exactly in the year 2000. Okay. From the year 2000 until right now, what's been going on with this property? Who's been there?
It's been rented.
Okay. This is a huge deal. And
I know.
well, what I'm going to do for your benefit, Karen, is I'm going to jump like 5 slides in our presentation.
Oh.
I'm going to talk about the biggest thing that people don't understand. Okay. You see this right here? That slide says, don't move in for 2 years. And the reason why is that on January 1st of 2009, the rules changed regarding rental properties. Okay, it's huge. It's like when we think of that $250,000 exclusion, what we're thinking about is something called Section 121. Okay, and that's going to be you live in it for 2 of 5 years, and it's $250,000 per owner. Okay, so a spouse. Spouses could do 500,000, yeah. But the problem with section 121, as of 1/1/2009, there's a concept now called non-qualified use, which is really proportionality. Okay, and I'm going to explain this in great detail momentarily, but if you want to move into this property, I'm not going to be mad at you if you want to live in it because you think it's a nice house in a nice area.
Right.
I'm going to strongly caution you against it if you're trying to get the 205-year exclusion, because it won't work.
And this is one thing I want to just pause on, and I talk about this with Jesse all the time. That's why I wanted to harp on the 205, because I can't tell you how many calls I get from people where their strategy is that they're going to move into their rental for 2 years so that they can obtain the $250,000 or $500,000 exclusion if married. And unfortunately, that's no longer the case. And so it's really important that people understand this before they make a huge decision like moving across the country to their rental property, because the game is different, right, as far as how it's rated.
So this is IRS publication 523, and I'm going to try to speak in like normal English to help us understand this. But
Maybe.
yeah, just normal, not tax gibberish. Look, what it says here, let's start with step 3. How long have you owned the property? Well, we've owned it since 2000. Really, if I was thinking, I would have said, 2022 minus 1992 would be 30 years. So really, we're trying to figure out some number of years of ownership, right? The IRS wants to know how long have you owned it, and then they want to know this, and this is horrible. They want to know how many days after 08, which is 1/1/09, have you owned it but not had it as your primary residence
The whole time.
Yeah. Well, so now look what happens. Okay, so if we add a little ticker here. Okay, so 2009. Okay, so all that time until now, we've had this as a rental, right? Now it was rented before, but this law only impacts the time after 09 that was rented. Okay, and let's see if we can put some what do you call it? Just some, not numbers per se, but put some posts here. Like, look, okay, if you moved into it today in 2022 and you lived there for 2 years, okay, you could say that you lived in for 2 of the last 5 years, right?
Right.
But now we're going to say, and I know the IRS says days, but for our sake, we're just going to say years. So you would have owned it for 24 years. Okay, 24 years owned. Now, from 2009 to 2022, it's 13 years. So 13 years of the 24 years, it was rented. Okay. So the IRS is going to say, all right, well, 13 years rented, 24 years owned. 54% of the gains are not eligible for section 121 exclusion. So now we're going to put easy numbers on here, just easy. Okay, we're going to say when you inherited it, it was worth $100,000, and you're saying today it's worth 1.25. I'm making it up, right? Okay.
Right.
So in this scenario, the difference between that and $100,000, I mean, you're at 1.15. It's more than $500,000 to begin with, but half of it wouldn't be eligible anyway. right? So we're going to go back to this PowerPoint because these numbers are a lot easier to digest. If you bought it for 100 grand in 2010 and you were going to sell it in 2020 for 600, there's your $500,000 gain. You're married jointly. You'd think no taxes are due. The problem is it was rented for 8 out of the 10 years. So 80% of the gain, 400,000, isn't eligible. Even though you have a $500,000 gain, even though you live there for 2 years, you can only not pay taxes on 100,000. And that's such a big deal, right? Because in your situation, Karen, living in this property for the next 2 years, maybe it helps you a little, because there's been so much time here that property values have gone up so much in the last 20, 30 years. Maybe it gives you a little help, but it's not going to reduce the entire gain by any means. That makes sense? Like,
Yes. Yeah.
And so one of our other strategies here, I'll show you a strategy that we worked on just last November. It was really, really interesting. It's kind of close to your situation. So you had a brother and a sister, okay, that the parents gifted them the property in 2000, okay? This is the huge deal too. This is so important. I'll explain why in a second, okay? So the mom was the second to die, and she died in 2020, and then the house sold in 2021. Okay. Well, they bought the house for $15,000 in 1970 and gave it to their kids in 2000. When you give your kids a gift, your purchase price and improvements go to your kids, right? They don't get a step up in basis on a gift. So when the mom died, it was worth $1 million, and they sold it right after. So they sold it for actually 1.1. What to do in this situation? You sell a property with $1 million gain, you're looking at somewhere in the neighborhood of 30% in taxes. That would have been about $300,000 in taxes due. When I interviewed these clients, I said, well, let's say taxes weren't a thing. If you sold this property, what would you do with the money? And they both the brother and the sister said, oh, you know what? We're just going to put it in the bank and we're going to, use it for additional income. And I'm like, wow, we've got the best strategy for both of them. And my cheat in business is the fact that I'm an enrolled agent licensed by the IRS and an investment advisor licensed with an SEC firm. And so I'm analyzing the situation from two different angles. Since they didn't need the money lump sum and they were willing to take it out over time, what we ended up doing is utilizing a Section 453 deferred sales trust. And I'm getting way ahead of myself, but this strategy is based upon the old installment sale, where the seller carry. If I have a $500,000 gain and I pay taxes on $500,000, I'm going to lose about a third in taxes. But if I get $50,000 a year for 10 years, maybe I don't pay any taxes. Why? Because the capital gains brackets are such, you can make $83,000 a year as a married couple and not pay any capital gains taxes. It's amazing. In their situation, what I did, we created a business trust. They sold the asset to the business trust. Now, this is different than your personal family trust, A, because there's a business purpose to it, and B, because there's a third-party trustee that's not you, not related to you. But we basically sold the property to the trust sold it to the buyer in escrow, money came into the trust, and then we started doing monthly payments. And this is pretty similar. The $900,000 sales price, Here, 100 grand would have been due at close of escrow. Maybe 2 grand a month if they were reinvesting it. But here, we were able to completely eliminate those upfront taxes and get them substantially higher monthly income. And how did we do that? By utilizing the deferred sales trust in section 453. It's kind of interesting, huh, Karen?
Yeah, I wanted to also recognize that, look, I know Jesse's jumping from a couple different vehicles. And I trust that by using examples, it's kind of helping understand and right, articulating the information. So that's really the goal here, right? But
all of this stuff is complicated, right? But if we can try to put in real world examples of how to make, all we're trying to do is live within the rules. We didn't make up the rules, right? We just have to figure out how to apply, and going back to Karen. So one has a child, her half will go to her 2 sons. What about the remaining sister? Well, we've kind of talked about how moving back into the property isn't really going to help her avoid, a bunch of capital gains. I mean, actually, because in this example, the numbers are so great. I mean, technically, if you inherit it for 100 and you sold it for 1.25, you would actually be able to protect $250,000 of the gain utilizing section 121, but you'd still have, what, a $900,000 gain.
And Karen, we're assuming that, in this example, that you're moving into it for the purposes of saving money on taxes, and yet we know that's not the reason why we're moving into it, just so we acknowledge that, correct?
Yes, that's right. We're moving into it to, number one, do some improving, not triggering a reassessment, because I talked to the tax assessor's office. And as long as you're not pulling a permit for anything, like a major permit, adding square footage or pool or whatnot, you don't have to worry about a reassessment. But our reason was that we wanted to live in the house, make the improvements, live in a warmer climate. We live in Oregon, which is right now, yesterday morning it was 3.5 degrees. So we're just kind of ready to do this, but it would be probably my more or less permanent home, depending on the family situation. So having said that, I will continue to pay my sister a little rent as we've collected all these years. Not a lot, but it's, it's something. And I will foot the bill on any improvements on the inside, which they need, and we need windows and, probably a roof and some yard work, that kind of thing. So that's kind of where we are in this thing. We have a year left on the lease. The people, we've already told them that we would probably not renew their lease. So they're notified. And if all goes as we plan, this is what we think we would like to do. Now, my husband is not on the title and doesn't intend to be. We married late in life, and so our trusts are entirely separate.
Mm-hmm.
Okay, so that's about where it stands.
And so let's say that your half is going to your trust, right? And your trust is going to,
yes, exactly,
to your children. And your sister,
she has a trust.
And she has a trust. So
yes.
On that end, I was thinking just in my head a second ago, I was like, well, I wonder if she should buy out her sister. The problem is you buy out your sister, what happens?
It'll trigger a reassessment.
Right. So
yeah.
Better just play nice, right?
Right.
So having said that, if we're trying, this is a very complicated situation with Prop 19.
I know.
Right? because
Right.
one of the components that you have to deal with Prop 19 is the fact that you have to file a primary resident, right there. You have to file a homeowner's exemption with
Yeah.
1 year of the transfer. Now that obviously that didn't happen. That didn't happen from 20 years ago.
No.
Right? But I would say you're going to file a homeowner's exemption living in the property because your goal is to transfer your portion to your adult child. What I'm
2 children.
to the children, right? Now the question is, are they going to live in the property? Do you think they would actually live?
No, I don't think either of them will do that. So this is a question that I have. Is it better not to transfer to them? Is it better to sell out before I leave the planet? Or
And Karen, it actually, your situation becomes very easy, actually.
oh,
And it's because of this. Prop 19, you have to be the primary, it has to be your primary, and I believe you're coming down from the cold to here, cool, it's your primary. But it then has to be their primary. And if they're not going to live there,
no.
Prop 19 becomes a moot point.
Mute point, right.
You're still under Prop 58 and 193. But by the way, 58 was parent to child, 193 was grandparent to grandchild. But the point of it is, I don't even know if I'd file the homeowner's exemption. I would probably leave it all status quo.
Okay. Well, we pay a rental tax every year, and they ask if you are the resident or if you are renting it.
Right. And that's the homeowner's exemption. But by the way, it'll save you like $70 a year. It's not.
Yeah, it's not a big deal.
Right. But the bigger thing is, and if it's okay with everybody, I'm actually going to just jump a couple slides to where we would have normally been in the presentation because this is a perfect time. The question is it a good idea to sell your house today?
I don't know.
I'm no real estate agent. I know Nick's a pretty good agent. This is just from Zillow, and people love Zillow, hate Zillow. I'm just using it for unbiased data. Look, these are our trends. We are currently in an environment where San Diego property values have reached, and check me if I'm wrong on this, but I understand we are now the least affordable area in the country.
So that's what it looks like.
From a value of real estate to average income standpoint. So our property values are the highest they've ever been.
Right.
And if you're considering passing on wealth to your children, you kind of have a couple of, like, these are your options. Okay. If you pass it on to your adult children through your trust, and your sister passes on through her trust, then they can sell the property just completely tax-free, one and done. The only issues there are the transference of your individual pieces through your trusts as you all die, which may be a massive headache. I don't know. But the other part of it is trying to think through, okay, well, if they're going to just inherit it and sell it, is it possible, or would it be advantageous to sell it now, lock in the higher gains, and structure, it depends on the total nature. If do you 1031 exchange it? Do you sell it for income? But you're going to want to live here, so it makes it a little more difficult, right?
Well, yes, but if it's more tax advantageous to sell at this point, we could probably buy something else. But it's kind of trading apples for apples in a way.
Yeah, and the
Because
bigger,
then you've got higher taxes from the
Yeah.
get-go.
what makes me a little nervous is the split between the sisters. Not that that's insurmountable. It just makes me a little nervous.
Yeah.
You know, if you live in there as your primary and she has her half and you're going to pay her maybe half the rent, right? To make her whole.
Right.
Basis.
Right.
Seems reasonable. But when it comes to just pure taxes, the analysis that we would have to do is, given your current financial situation, your own income, your social security, everything there,
Right.
and factoring in your age, could you sell it right now? And could we keep you in the 0% tax bracket? If that's a possibility, then I would say, yeah, that'd be a great idea to sell it. How do you get in the 0% tax bracket?
Yeah.
You just have to defer the taxes over time. And that's going back to the Section 453 strategy. So I think this has been a great discussion. I'm just concerned that without really diving into your situation, I can't give you more actionable stuff.
Right.
Yeah, we'll let you guys, right, have a conversation off air if that makes sense and you'd like to figure out more. I want to make sure, right, we do cover any other
Sure.
information that's pertinent, right? Because we are running over. So I do apologize for those in attendance. If you do need to go, this will be recorded and sent to you. But with that being said, I want to make sure we work through a few of the remaining information so that we can get through any other good stuff available for the rest of the audience. Thank you so much, though, Karen, for putting your situation out there. And that's been really helpful. And I hope that that's helped other people maybe solve other questions they had through that
Yeah.
example.
Thank you for the time.
Yes.
So here's old Section 121. This is and we kind of addressed this a moment ago. Here's your 2 of 5-year exclusion, but really it's 2 of 2 years, right? What I see happening more and more, people not living in a house for 2 years because of situations. The most common one in the last 24 months was what? COVID, right? So there's the unforeseeable event exclusion. If you've become unemployed or unable to pay your bills, you're able to take a partial exclusion, and it's all time-based. So here's somebody that bought their house in 2020, 400 grand, lost her job a year later. They've got a $100,000 gain. They haven't been there 24 months, but they could still sell it. Single or married, doesn't matter, because we would take their full exclusion amount of 250 times 50%, that's 125. That's greater than 100, ergo no capital gains taxes due. Okay, this is not called anywhere the COVID exception. It's called the unforeseeable events exception, but it absolutely works for COVID. Okay. Additionally, the health-related move. I had a Marine I was talking to recently. He bought a house near Temecula, California. He's down here in San Diego as a drill instructor. He had a preemie baby, and although he thinks his baby is well and good and healthy right now, all the therapists are here. So selling his house before those first 2 years are up, slam dunk. We would be able to help him sell that with no taxes. And that's a irrefutable deal. Just the fact that he had a preemie baby, right?
Jesse, is there a certain distance associated with that?
Not on the health related moves. It's really interesting. For work it is, but not health. And this is right there. It's just, you had to sell because of your situation. Right? And I keep referencing this. I think this is awesome. IRS Pub 523. It just tells you, I mean, yeah, it's tax gibberish, but on my end, trying to help people navigate these waters, I like saying, hey, look, here's your work related move, 50 miles more, health related, you're taking care of somebody that you care about. And the unforeseeable events exclusion, you know, were you eligible? And I literally copied those verbatim. Yeah. Were you eligible for unemployment? Okay. We've already talked about non-qualified use. Huge deal. You know, Karen's got a unique situation, but I see all the time people in California renting out their property and then moving back in for 2 years because they're trying to get that tax-free. Now, it was the law. That's how things worked before January 1st of 2009. Okay. But I guess do not disturb doesn't work for some reason.
Jesse, you can't show that you're busy. What are you doing, man?
It's only tax season, right?
A webinar.
But I got it on do not disturb, man. Oh, well, whoever wanted to talk. So in any case, we do this too much here and it doesn't work. So please don't do it. Don't move back to a rental because you think you're going to kink the system. It's not going to work. If you want to move back to the rental because it's nice to live in, that's okay. Right? Again, 1031 exchange, you got a rental property. It's awesome. You can exchange it. If you're an out-of-state owner, be careful. Okay. California FTB 3840. This is an information filing form that you have to do literally until you die, you donate the property to charity, or you decide to pay taxes. And I'm not kidding. I didn't make that up. This is directly from the source. It says in government gibberish, you die, you donate the property, or you pay the taxes. The worst thing that California does from a tax standpoint is that they will arbitrarily assess taxes. They'll literally just make things up. And then if you don't reply to the notice, they'll condemn you to guilty. Okay. And it's all simply about filing the form. So if you're doing a 1031 exchange from a California property out of state, just please make sure you do this form every year. Okay. Now, if you're in a situation where you're tired of toilets, tents, and trash, and you want to sell your California property, but you feel like you're going to lose too much in taxes, this is where we go into the Section 453 installment sale. And like I said earlier, it's just a matter of, you only pay taxes on what you receive. So $500,000 gain up front, you're losing $150,000 in taxes. You take $50,000 a year for 10 years, maybe you hit the 0% tax bracket. Maybe you don't pay any taxes on it. Okay. By the way, that brother-sister story I talked about earlier, did you know that we split this on 12-year notes? Brother ended up paying $700 a year in taxes, and the sister didn't pay any. God bless America. It's not a loophole, it's a structure, right?
And this is something, Jesse, that I just want to harp on. This is exactly the value in having good advice and current information. Because what we find a lot is that clients, CPAs, or tax advisors are typically against anything they don't know anything about. So just make sure, I think the most important thing is that you have all the information from both sides and that, you know, you can make an informed decision from there, because we see a lot of these just lack of planning or lack of information, right? And it's okay, right? You're or have a relationship with someone you've been with for 10, 15, 20 years for a CPA, but yet don't let that get in the way of making sure you have all the information to make informed decisions. So Jesse, for the sake of time, I just wanted to make sure we quickly jumped into the cost of living increases. So everyone saw the standard deductions, Social Security, all that good stuff.
Sure.
And then understand too that there's a lot of information here. So it would make sense that, you know, we're going to have a call specifically on a deferred sales trust, right? So that we can get more detailed on it, because it is a complex conversation for this space.
Absolutely. Yeah. Oh, it's brain damage. I'm not going to lie to you. It's hard. Having a little technical difficulties here, Nick, but we'll go right to what we were talking about. This is the cost of increases, cost of living that's going on. What you're going to find is if you're under 50 and you're still working, you want to put money in a 401k, awesome. 20,500, 27 grand if you're over 50. Additionally, if you're not yet 67, but you're taking Social Security, you can now earn $19,500 a year, $19,560, and not have your Social Security lowered. Standard deductions now up to almost 26,000 for a married couple. And the thing that I'm frustrated with is this right here. Now, this is really, for the vast majority of people, it has no bearing, but in order to qualify for Social Security, you need to have 40 quarters, which is what? It's 10 years. But now what this is saying is you need to make at least $1,510 in a quarter for it to count. And I know that if you're making $500 a month, I mean, you're already kind of in a bad spot, but you have to make $504 a month now just to qualify for Social Security, right? So that I don't know. I don't like that. Let's see. If we go back to this slide, Nick, we're just going to jump down and say, listen, our recap is this. We've talked pretty much no big changes, right? We got Prop 19, and at least 3 strategies of selling your home. Section 121, the 2 5-year exclusion to 5,500. Don't move back into the rental though. Okay, if you're selling your primary and you've got a situation where you can't sell, you got to sell it for 2 years, maybe we can help you protect some of that or all of it. 1031 exchange are still around. If you want to invest out of state and take a $1 million California property for 330 properties in Texas, that's cool. Just make sure that you keep filing the annual California form. And if you want to take your chips off the table and not reinvest in real estate, Section 453 deferred sales trust, that really works nice, especially if you're tired of toilets, tennis, and trash.
Well, thanks so much, Jesse, for your time. I trust that everyone got some good information, reliable advice. And Jesse, yeah, if they want to get a hold of you, where do they go?
Yeah, best roadmaptax.com. All of our contact information is there. Actually, my sister Rachel was on the call listening to all this. So she's got a great handle on what's going on. And we're not H&R Block. We don't do taxes until April 15th, right? We're a tax planning company. We're honestly just as busy in July as we are in April. It's pretty awesome.
Well, again, hey, thanks so much, Jesse, for your investment of time and great insights and information. I trust you guys all got something out of it. And next month, we're going to do a case study for a client who did do a 1031 exchange locally from a condo and reinvested into 3 properties out of state. And through that, we're going to go through all the numbers and what that did for him as far as a passive income stream and long-term wealth accumulation. So look forward to seeing you guys on that call. And thanks so much for your participation today, Karen. We appreciate it. And wishing you guys all a wonderful weekend ahead. Cheers.